There is a rule in the tax code that forces you to start pulling money out of your retirement accounts whether you want to or not, and if you ignore it, the government will take 25% of the amount you were supposed to withdraw as a penalty. That's not a typo. 25% gone, just like that. Not because you did something wrong with your money, but simply because you didn't take it out on time. This rule is called required minimum distributions. Most people call them RMDs, and if you have a traditional 401k, a traditional IRA, or most other tax-deferred retirement accounts, this rule applies to you. And yet every single year, thousands of retirees either forget about their RMD, miscalculate it, or make a timing mistake that costs them a fortune in penalties and taxes. So today I'm going to explain exactly how RMDs work in 2026, when you need to take them, how much you need to take, and most importantly, how to avoid every common trap that catches people off guard. By the end of this video, you'll understand this rule better than most financial advisors explain it, and you won't have to pay anyone a dime to figure it out. Let's start with the most basic question. What is a required minimum distribution? When you put money into a traditional IRA or a traditional 401k during your working years, you got a tax break on that money going in. The government said, fine, we won't tax this money now, but eventually you have to take it out and pay taxes on it. RMDs are the government's way of making sure eventually actually happens. Think of it like a deal you made decades ago. You got the benefit of tax-deferred growth for years, and now the bill is coming due, one withdrawal at a time. Starting at a certain age, you are required by law to withdraw a minimum amount from those accounts every single year. And you must pay income tax on every dollar you pull out. You can always take out more than the minimum, but you can never take out less. That's where the penalty kicks in. Now let's talk about the age. When do RMDs actually start? This has changed several times over the past few years, which is part of why so many people are confused. Under the old rules, RMDs started at age 70.5, then it changed to 72, and now under the current rules for 2026, your RMDs begin at age 73. If you turn 73 in 2025, or will turn 73 in 2026, this is your year to pay attention. And there's already a scheduled change coming. Starting in 2033, the RMD age will increase again to 75, but that doesn't help you if you're 73 right now. One important detail, Roth IRAs do not have RMDs during the owner's lifetime, which is one of the biggest advantages of Roth accounts and something we'll come back to later. Now let's get into the math. How much do you actually have to withdraw? Your RMD amount is calculated by taking your total account balance as of December 31st of the previous year and dividing it by a life expectancy factor from the IRS Uniform Lifetime Table. That sounds complicated, but let me show you with a simple example. Let's say your traditional IRA balance was $500,000 on December 31st of 2025, and you are 73 years old. You look up age 73 in the IRS Uniform Lifetime Table, and the factor is 26.5. You divide 500,000 by 26.5, and your required minimum distribution for 2026 is approximately $18,868. That means you must withdraw at least $18,868 from your traditional IRA during 2026, and you will owe income tax on that amount. If your balance is higher, your RMD is higher. If your balance is lower, your RMD is lower. The formula adjusts every year based on your new balance and your new age factor. And here's something that trips people up. If you have multiple traditional IRA accounts, you add up the balances of all of them to calculate your total RMD, but you can take the withdrawal from any one or any combination of those accounts. However, if you have a 401k and an IRA, you cannot combine them. The 401k RMD must come from the 401k, and the IRA RMD must come from your IRA accounts. Getting this wrong is one of the most common mistakes, and it can trigger the penalty even if you technically withdrew enough money total. Now let's talk about that penalty, because it's the whole reason this topic matters so much. If you fail to take your full RMD by the deadline, the IRS charges a penalty of 25% of the amount you should have taken but didn't. So using our earlier example, if your RMD was $18,868 and you forgot to take it entirely, the penalty would be roughly $4,717, just gone, straight to the government. Now here's the one piece of good news. Under the newer rules, if you catch the mistake and correct it within 2 years by taking the missed amount and filing the right paperwork, the penalty drops from 25% down to 10%. 10% is still painful. That would be about $1,887 in our example, but it's a lot better than 25%. And under the old rules before 2023, the penalty was 50%. So at least the law has moved in the right direction. But the smartest move is to never miss your RMD in the first place, which brings us to the deadlines. For most people, the RMD deadline is December 31st of each year. You must take your full required distribution by the last day of the calendar year. But there's a special exception for your very first RMD. If 2026 is the first year you're required to take an RMD, you can delay that first one all the way until April 1st of 2027. That sounds like a nice gift of extra time, and on the surface it is. But underneath, it's actually a trap that catches thousands of people every year. Here's why. If you delay your first RMD to April of 2027, you still have to take your regular 2027 RMD by December 31st of 2027. That means in 2027, you would take 2 full RMDs in the same calendar year, one delayed from 2026 and one for 2027. 2 large withdrawals in the same year means a much larger taxable income, which can push you into a higher tax bracket, increase your Medicare premium surcharges, and even cause more of your retirement benefits to become taxable. For most people, the smarter move is to just take your first RMD in the actual year it's due, even though you technically have until April of the following year. You avoid the double up, you keep your income smooth, and you prevent all those nasty side effects. Now let's talk about strategies to handle your RMDs in the smartest way possible. Strategy number 1. Take your RMD early in the year instead of waiting until December. A lot of people procrastinate and wait until the last few weeks of December to take their RMD, which creates risk. What if you forget? What if there's a processing delay? What if the brokerage firm takes a few extra days? Taking it in January or February gives you the entire year of cushion and eliminates the stress of a year-end deadline. Some people even set up automatic monthly or quarterly withdrawals from their IRA to satisfy their RMD gradually throughout the year, which also helps with cash flow and tax planning. Strategy number 2. Use a qualified charitable distribution, also called a QCD. If you're 70 and a half or older and you donate to charity, you can direct up to $105,000 per year from your IRA straight to a qualified charity. That amount counts towards satisfying your RMD, but does not count as taxable income on your tax return. Let me say that again, because it's one of the best tax strategies available to seniors. The money goes to charity, it satisfies your RMD requirement, and you pay 0 tax on it. If you were already planning to donate to your church, a nonprofit, or any qualified organization, doing it through a QCD instead of writing a personal check is free money saved on taxes. Strategy number 3. Consider Roth conversions in the years before your RMDs begin. If you're in your 60s and your RMDs haven't started yet, you have a window of opportunity to convert some of your traditional IRA money into a Roth IRA. Yes, you pay income tax on the amount you convert, but once that money is in the Roth, it grows tax-free, comes out tax-free, and is never subject to RMDs. By doing partial Roth conversions over several years, you can shrink the size of your traditional IRA, which means smaller RMDs when they eventually start, and less forced taxable income in your 70s and 80s. This isn't the right move for everyone. But for people with large traditional IRA balances who expect to be in a similar or higher tax bracket later, it can save a tremendous amount of money. Strategy number 4. Know what accounts do and don't require RMDs. Traditional IRAs. Yes, RMDs required at age 73. Traditional 401k accounts. Yes, RMDs required, unless you're still working at the company that sponsors the plan and you're not a 5% or more owner, in which case you can delay. Roth IRAs. No RMDs required during your lifetime, which is why Roth conversions can be so powerful. Roth 401k accounts, starting in 2024, these are also exempt from RMDs during the owner's lifetime, which is a recent and very welcome change. Knowing which accounts have RMD obligations and which don't helps you decide where to keep your money and where to draw from as you age. Let's quickly talk about what happens to RMDs when you pass away, because this affects your family. If you have required distributions and you pass away during the year, your beneficiary is responsible for taking any remaining RMD for that year that you haven't already taken. If they don't take it, the penalty falls on them. The same 25% rule applies. Making your family aware that this responsibility exists is a simple conversation that could save them thousands of dollars during an already difficult time. Let's recap everything we covered today. RMDs start at age 73 in 2026. They're calculated using your prior year-end balance divided by an IRS life expectancy factor, and the deadline is December 31st each year. The penalty for missing an RMD is 25%, reduced to 10% if you correct it quickly. Avoid the first-year trap of delaying your initial RMD and getting stuck with 2 withdrawals in 1 year. Use strategies like early year withdrawals, qualified charitable distributions, and Roth conversions to minimize the tax impact. And make sure your family knows about RMD obligations so they're not caught off guard. If this helped you understand RMDs clearly for the first time, hit subscribe, because every week I break down retirement money topics just like this in plain simple English, and I'll see you in the next one.